Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that help boost your trading potential. Coming up, markets have been remaining remarkably resilient despite geopolitical uncertainty, but can earnings justify today's lofty expectations? Veteran Canadian strategist John Zechner is going to join us. He'll discuss why he's taking a more defensive stance, what he'll be watching from the big tech sector, and the sectors where he still sees value. Then, with earnings season set to kick off next week, we're going to break down the chart on JP Morgan and also explore option strategies that traders can use to position for both sides of the trade. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. Half an hour to the trading day. It's all about the chips again. Quite a roller coaster ride. They are putting points on the table today. It's got the S&P 500 up about 0.5% as we start the trading day. Let's get into perhaps the heat map. We'll start to see some of the chip makers and maybe find a reason why as to their reacting this way. Micron, Applied Materials, Broadcom, AMD all putting points. SK Hynix, this is the South Korean memory giant. Its ADR going to be listed on Friday. Apparently, according to reports, 7 times oversubscribed. So maybe this has people and investors excited about the chip and the memory names again. Across the rest of the board, we have some big names, though, mildly lower. NVIDIA, Google, Amazon, pulling us back from a better showing. Earlier this week, we put PepsiCo on your radar in terms of their earnings. While they have reported weaker than expected quarterly earnings, they did top on sales estimates, but that was the strong international demand. Apparently here in North America, we're seeing weakness in demand for snacks and drinks. Company put that down to stretched household budgets because of inflation, but they are standing by their full year forecast. You put it all together, we got PepsiCo on a downward slide today. And that's your market update. Joining me now is my colleague here in Amin from our direct investing educational team, and John Zechner, chairman and lead equity manager with J. Zechner Associates. Gentlemen, thanks for being here with us. Before we jump into the conversation, just want to remind our viewers that the views and forecasts expressed are solely those of John and his team at J. Zechner Associates based on their research. John, we got lots of uncertainty out there, geopolitical uncertainty flaring up again. From day to day, I don't know if the market's concerned about what the hyperscalers are paying for their memory or if they're not. How have the markets been so resilient through all of this turbulence?
Well, I think, Greg, earnings obviously have been a great backstop for them, and the whole push behind the AI build out. I mean, when you look at it, it's when you look at what the hyperscalers have spent so far this year, or the run rate of $700 billion. That's a pretty massive tailwind for the market overall, and the ancillary spending that falls out for the Caterpillars of the world and the electrical utilities and the build outs there. So I mean, to the degree this is a real next industrial revolution, and AI is going to increase the productivity and in earnings of companies going forward and ultimately push inflation down. I mean, that's the real optimist, bullish view out there. I mean, yeah, that's going to sustain the market. I mean, I'm sort of on the other side of that one, having done this 45 years. I always get concerned when sort of everyone's in, everyone loves the story, valuations are at all-time highs, and you're really running an economy that in a sense is a one-legged stool, one very big fat leg, which is his AI spend. But beyond that, I'm a little concerned that it's not as rosy as sort of might be indicated by what's going on, particularly in the chip sector and the AI spending.
You've become more defensive in the portfolio, you were telling us, not because the market's about to roll over, but these high expectations as you laid out. What do you need to see from earnings season that would change your mind, get you a little more constructive on the market?
Well, I guess maybe a broader base of earnings that goes beyond all the companies that are directly related to strengthen the stock market and strengthen AI. I mean, like I say, we've seen it from some of the industrial complex companies, some of the ones like I mentioned, Caterpillar, and then the electrical utilities, and obviously the chip companies have been huge winners. You see it spread beyond that. I mean, to me, a better indicator of what's going on in particularly the U.S. economy is Walmart, and then we have Pepsi earnings this morning, and those things have not been that great. I mean, I don't think it's an overall strong economy. I think it's an economy that's driven by, a small part, and that's fueling obviously gains in the stock market, which gives you a wealth effect, and that helps the banks. I'd like to see it beyond that. I'd like to see a better overall growth and something that makes me think this is going to be more sustainable, as opposed to what happens when you get something like 2 weeks ago where the rumor is that Meta's going to slow down their spending maybe on AI. Does that go across the other hyperscalers and you turn off this huge tap? I mean, that's what happened in 2000, Greg. And I mean, that's when we saw, the end of the tech run there is once all that telecom spending slowed down and everybody looked around and said, oh, hey, by the way, we have too much capacity. We have too much fiber into the ground and no one's paying for it. And then you had a collapse. So those are the things, like I say, that just makes me cautious. We're never going to run away from the market totally. When I look at companies now, I'm looking more at, the valuation. What's my protection on the downside? What's the economic sensitivity, as opposed to saying, give me a high beta play on continuing exuberance about AI in general.
John, and I know you just mentioned the earnings season obviously kicks off in earnest next week. We've got the banks reporting, and the bar is high this time around. Even Wall Street's looking for the S&P 500 earnings to grow north of 20%. This is for a second straight quarter, with estimates actually getting revised up through the quarter, which almost never happens. So when the numbers actually do land, what is the one thing that actually matters to you? Is it about the beat? Is it about the guidance? Or is it where that growth is in fact coming from?
It's that last. It's the breadth of the earnings and across the board. Because when you look at it in the last quarter, I mean, over 50% of the earnings growth is coming from a few companies in tech. I mean, you throw Nvidia and Micron in there, and that's a lot of it right there. So it's so concentrated. Obviously, that's giving you strong stock markets. So the banks have that tailwind of wealth management, and capital markets have been great for them as well. But I mean, you look at I would love to see for banks to see some improvement in the loan book, a little bit of loan growth or something like that. So I think you've got to see a little bit more sort of breadth of earnings and across other sectors. And you got a little hint this morning. You got like I say, you got the Pepsi numbers, which didn't blow anybody away. It just shows spending is sort of still tepid in the U.S. So you want to see it a little more broad based. I'll be picking apart the earnings, and even within tech, you got who's doing better. And I think the biggest indicator by far is what you're going to get out of those four hyperscalers. They're not all reporting on the same day this time like they did last quarter, but there's two big pieces of information they're going to give us. One is their capex continuing at the same rate or even increasing? I mean, it's probably going to go a little bit higher because the price that they're paid for memory is going up. And are they monetizing this? So what is the growth of cloud? I mean, if you turn around and Microsoft, it will say Azure and AWS for Amazon and Google Cloud are all suddenly growing at 40% plus rates, their cloud, and increase. And maybe they can justify that they're starting to monetize AI very effectively. And that may make people a little bit more comfortable with what they're paying. But in the meantime, the markets are worried about how these cash flow machines over the last couple of years, free cash flow machines, have turned into, net negative free cash flow machines. They're raising debt, they're raising equity to finance this, and that's a concern.
So let's talk about that, John, because obviously, the earnings is fueled by these hyperscalers and tech in general. I mean, you mentioned it off the top. Those hyperscalers are looking to spend about $725 billion this year alone. So at what point do investors need to start seeing real returns or monetization of that? Because we haven't heard it. We've just seen CapEx increasing instead of just those bigger numbers this next quarter around again.
Well, I think they're already starting to question a little bit. I think that's a bit of that SaaS apocalypse move is what you're seeing is that the software, the old style, software license companies are not will be sort of eradicated or they were diminished in terms of their growth going forward, and that's taken the stocks down to very low levels. I mean, look at Adobe trading at 8 times forward earnings, or Salesforce at 12 times. So I mean, impatience will arrive in a hurry, and I think that the action of the hyperscalers, even in the past 2 months, gives you a little more indication of that no, you've got to stop borrowing. And look at Oracle. Oracle traded north of 300 last September, and then what's around 140 today. I mean, that's a pretty significant drop for a company that has beaten the earnings estimates the last 2 quarters simply because people are worried about their ability to finance this growth going forward. And then, do you really need all these large language models? Are they all going to be profitable? I don't know. What is the real difference between Chat GPT and Gemini and Claude and, or can you get a cheaper model off the DeepSeek, and how do the companies incorporate it? There's so many questions to be asked. And I think investors are going to be a little more circumspect about asking these questions. And as they do, I think the stocks are a little bit more at risk. They're not just going to assume the growth story is up, up, up.
So, John, with a market this dependent on a handful of companies, you talked about you taking a look at the Walmarts of the world. You threw Pepsi in there, of course, reporting today. They're all saying the consumer's a bit tapped out. We keep getting this narrative that the market rally is broadening. It's broadening. And some days I see healthcare go up in the States and consumer stocks, but then they pull back. What do you need to see to say, okay, we're actually seeing a broadening here and this is becoming a healthier rally?
Well, it's broadening, Greg, you're right, but it's broadening for a simple reason, is that there was such a concentration in a few large companies that when they start to underperform, if people don't want to take their money out of the market altogether, they sort of go to these other sectors, and it takes so little money to make those prices move more dramatically. When you take, trillions of dollars out of, the top, 6 or 7 stocks, and spread it across the rest of the index, you get a bigger impact and hurry. Doesn't mean those companies are necessarily doing better. I want to see what the earnings look like. You take technology or the big tech companies out of the earnings growth picture, and you're not even in double-digit rates. That's hardly, an earnings boom. So I'd like to see something a little better than that. And like I say, even take it beyond that, take out of capital markets activities and wealth management activities that have, sort of buoyed the bank's earnings, and then what have you got left there? It's not that great a picture necessarily. So, like I say, I'm skeptical about it right now, and just, we're not getting out of the market. We're just being a little more circumspect about where we invest, and a little more conscious of, things that generate some income to protect the downside of lower valuations. And I don't need to, find the next thing that, might double or triple. I don't think there are a lot of more NVIDIAs out there in the short term are going to give you those kinds of returns. Or certainly you're going to not see a lot of, Micron over the last year kind of returns.
And John, let's actually bring it home now, because obviously it turns out broadening doesn't need a passport. When you look at the TSX, that's nearly up about 29% over the past year. It's quietly outrunning the S&P. So when you look beyond the AI trade, where's the best risk reward in Canada right now?
I think you're going to roll back to the industrials and resource sectors. So I think they're going to see some significant spending there. Obviously, Canada and the NATO nations, what they're talking about in the past couple of days about getting to 5% of their spending in defense. Like, that's almost a joke to me. They'll never get anywhere close to that number. I think once Trump's gone, they're going to realize they're just, sort of, paying lip service to, to that goal. I mean, it's almost like reminds me a little of when Justin Trudeau said we're going to have 100%, electric vehicles by 2035. It's not going to happen. Having said of that, with that sort of caveat in mind, defense spending will increase, industrial spending will increase, infrastructure spending is increasing. We will build pipelines. We will diversify beyond the U.S. because it makes sense to do in the longer term, and that's going to mean more capital projects in Canada. So to that degree, yeah, energy infrastructure looks interesting. The pipelines look interesting. I still like the telecom companies because they're so undervalued, and they're going to provide the framework for that. In that environment, financials should do all right. Because they're funding a lot of this. My concern is the valuation of Canadian banks versus U.S. banks versus their historical averages, and versus European banks or anywhere else. I saw they were down yesterday, a little sloppy because a few analysts are starting to point that out. While Canadian analysts are running around trying to justify why banks should suddenly trade at 15 times earnings instead of their traditional 10 to 12 range. I always get a little worried when we're trying to move the bar up to where we are, as opposed to looking at maybe where we end up or what the the long-term averages are going to be.
Let's talk about the Fed. We haven't hit on monetary policy south of the border yet. Obviously, the financial community looks to every word from the Fed. They want every hint they can get out of minutes and commentary. But we got a new Fed governor. How much is the Fed going to drive the bus for the rest of this year, given that Mr. Warsh says, I'm not going to give you much?
Well, I think, Greg, he's exactly telling you what everyone should be hearing, and they don't seem to be listening to what he says. He says, I'm not going to give guidance, to the degree it wasn't passed. There will be no dot plots. I'm not, I want to get, I'm determined to get inflation down, and we will look at the data. Maybe the old style data points aren't the ones that make the most sense. So that's what his committees are going to look at, or his task forces, in order to find out what is the best way to really measure inflation so that they can, control it effectively. But I think while they're doing that, it's going to give him cover, certainly not to raise rates. They won't cut rates, but I think they'll just back off and not do a lot for now. And it's sort of ironic that, Alan Greenspan passed away at age 100 2 weeks ago. And just around the same time, there was the first meeting of a Fed chief that probably looks more like Greenspan than anybody has since Greenspan and left in 2006. I mean, he's certainly not of the Bernanke, Yellen, and Powell sort of mold, which is more helicopter money and lots of guidance and using the balance sheet to try to implement monetary policies. Well, he's telling you straight out. It's like they're going to relook at this. I think ultimately he'd like to get numbers or interest rates lower. I think he probably believes there are disinflationary trends, and I think he probably had to promise that to the guy who appointed him as well, at least in the short term. But I tell you, to expect a lot out of this Fed. I think people are getting their hopes up, and it makes sense for what Warsh is saying, because I think in the end, all this guidance from the Fed, it doesn't really do anything. I mean, in the end, they're not necessarily much better prognosticators than the economists and strategists at a lot of the firms and anybody else who looks at the data. I mean, let's face it, that transitory inflation call of 2021 had to be one of the worst calls ever. And that drove policy for a while and forced them to, have to jack up interest rates pretty dramatically for the following 2 years in order to offset that. And they still, you're 5 years now running with inflation over their target range. So, they're certainly not going to be cutting rates in the short term, but I think Kevin Warsh has probably laid out a scenario where he's not going to have to raise rates because, hey, we're in the process of looking at all the parameters here and looking at how we measure inflation.
John, if we just keep on that theme, and we're just going to shift away from the Fed, as you know, when you look at the themes for the summer that's unfolding, obviously we're looking into earnings now, AI, obviously football mania is gripped by a lot of people, but we've also been gripped by IPO fever as well. And we don't have to look too far. SpaceX just had the debut a couple of weeks ago, largest IPO ever. On average, last year, the IPO popped, on average, IPOs have popped almost 30% on day one. This is prime FOMO territory. And so with a stack of big A-listers still to come, what's the biggest mistake for retail investors make when chasing these hot listings in your view?
Yeah, no, that's a good point to bring up, because I think investors make a big mistake generally. When they look at the SK Hynix coming tonight, all I hear this morning is, it's 7 times oversubscribed. Like, forget about the first couple of days' actions. People, should I try to play this deal? If it's a good deal, you're not going to get a big piece of it no matter what. You're going to get, unless you've got some dirt on the underwriter or something like that, it's just not going to happen. So it's assume. So you have to decide whether to buy it in the aftermarket. You got to realize in the aftermarket, you're bringing out small pieces of these larger companies. So it's easier for them to ride. And immediately on day one, day two, even if they're not index buyers like you didn't have with SpaceX right off the bat, you got the ETFs out there, the space ETFs or whatever, or the AI ETFs. They're immediately going to be buying. So you're going to get a lift in these things. You know what? Just step back. Look at this thing, sit back and wait. I was looking at some stats recently, the VWAP, the volume weighted average price of the first 2 weeks of trading for both SpaceX as well as Cerebras, so the last two really big deals. When I looked at what the VWAPs were in the first 2 weeks and then where the stocks are trading at now, in both cases, the stocks are down more than 20% from those prices, which means any investors who went into the aftermarket in the first 2 weeks and bought are now down 20 to 25%. So stay on the sidelines for a little. Look at that. Get to know the companies. I mean, one of the better ones we did over the past 20 years. I mean, I looked at Google, the Alphabet listing came out, or Facebook in 2012. And I remember that one well. We didn't own it. I didn't have Facebook at the time, but I remember my wife saying to me at the end that it was a sloppy deal and it went down. I was saying, I'm getting angry at Facebook. They're running ads all the time, and I'm on the other side thinking, hey, really? That's good. It means they're starting to monetize this. And then you look at it, and that's what drove growth for the next 10 years. The fact that they went from zero mobile advertising to about 90% of their revenue. That's what you got to look for. The only IPO I've bought into this year was Apotex, the generic drug company in Canada. And that's an interesting story in and of itself.
John, we have covered a lot of ground as we move through the second half of this year. What is the one indicator that you're watching to try to figure out where these markets might be headed?
Like I say, I'm going to pay a lot of attention, Greg, to, like I say, those hyperscaler earnings, what their growth is on the cloud side and what they're saying on the spending side, because that has been the big driver of the market. And, if I'm pessimistic, maybe that will be disproven. If these guys come out and say, okay, our spending is, going from 700 billion this year to $1 trillion next year and something beyond that in 2028, I'm going to have to rethink some of the, and relook at these chip stocks, that the cycles, they're not going to be the big cyclical play that they were. It's going to be a little bit longer and more sustaining than I expected. It also means that these guys will be generating more negative free cash flow for a longer period of time, and the hyperscalers would be under pressure. So, I want to hear what the narrative is. And like I say, on that one, I also want to hear how their public cloud growth is doing, because that's effectively the best way they're monetizing AI in the short term. That and some of the agentic AI players like, Shopify up here in Canada and all of that, who I think can sort of take AI and incorporate it into their offerings better and start to monetize it more quickly. So those are the kinds of things I want to look for in the earnings reports. But yeah, tech is and will continue to be the big driver. I mean, oil is back and forth, and that's geopolitical, and gold will continue to be okay, driven by the, what's going on in the central banks. The consumer in this K-shaped economy is still a little bit of a worry to me, because there's too much, of the wealth effect, and I don't know how sustainable that is, and they've run down savings rate, and that's a bit of a worry. So, there's a lot of balls in the air as usual. Well, that's what makes this all fun for us, Greg, and the way why we keep doing this is you'll never figure it out completely, but just keep watching these data points and just watch them as they come in.
Gives us a lot to talk about as always. John, it was great having this conversation with you. Hope we do it again real soon.
Appreciate it. Thanks.
That was John Zechner, Chairman and Lead Equity Manager with J. Zechner Associates. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only. It should not be considered investment advice, buy, sell, or hold recommendations. Here, and John said a number of really interesting things. I used to talk with John a lot in my former job. Always loved the conversation. I don't know where to start. Maybe we'll get back to this whole idea about, he's looking to the Walmarts. I mentioned Pepsi this morning in terms of what's really happening in the U.S. economy. Yes, AI is a big driver, but he called it, a one-legged stool. It's a fat leg, but it's a one-legged stool. But in the end, this is what's been driving the markets. This is what we got to keep our eyes on.
Yeah, it's one heck of a stool, Greg, I'll tell you that. Quite a balancing act, of course. But yeah, it comes back to that broadening theme. I think that's one of the things he focused on was when this earnings does come out, where are we seeing those pockets of earnings being driven from? And one of the things I was looking at, I wanted to see a sector look, Greg, just a breakdown so far year to date. And you'd be surprised. Tech is certainly up there, but it's not the leader. In fact, the industrials is, and I know John mentioned a couple industrial names in there that are actually, south of the border that are leading, 51% year to date. So we are seeing at least maybe the picks and shovels of those companies benefiting from some of the dollars that are coming in. But the second thing, Greg, was the big thing was this hyperscalers, if they do go through another round of, an increase in their CapEx, they're now dipping into the debt market. We know they're negative cash flow, but now they're looking to the debt market. We know some notable debt issuances that happen in Canada. Of course, Google, Amazon came out. So is this more of a trend to come? Are they still seeing that increase? If they are increasing, that means maybe there's still demand there. If they're going to slow down, especially with what he said with Meta saying they're speculating that they might not have as much demand as what they thought, then that could break the whole story.
All right, another great conversation. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. You just open a practice account. You click on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Now it is time for Technical Take. The stock in the spotlight is JP Morgan. Deal-making, robust trading activity has been powering strong revenue and earnings for the Wall Street giant, with the stock trading near record highs. And JP Morgan is returning cash to shareholders, authorized a $50 billion share buyback program. So with another earnings season kicking off next week, investors will be watching to see if JP Morgan can keep that momentum going here. And what are you seeing with the name?
Yeah, Greg, JP is the largest bank in America, obviously 4.9 trillion in assets when you look at it. It's obviously seen as a proxy of the health of the entire U.S. financial market. So this is a big one. It's actually going to headline a stacked open to the earnings season. You've got next week JP Morgan, BlackRock, Wells Fargo, Citi. You got Morgan Stanley and Bank of America the next day. They're reporting their earnings on July 14th pre-market. Expectation is about 564 in the EPS. That's going to mark about 13.7% year-over-year growth, and about 50.34 billion on the revenue side of things on the top line. That's 12.1% year-over-year growth. One of the big potential catalysts could be NII. This is a big number for banks in a whole. So if there's any upward revisions to that NII guidance, net interest income, that would obviously reflecting a more hawkish Fed and improved market activity, as you mentioned, with the capital markets. Also remember, banks are cyclical businesses, so any real or perceived reduction in economic risk is also going to be a positive on their outlook. So the three things, Greg, I think I'll be looking at when it comes to JP Morgan is, one, Jamie Dimon sounded the drums on this, was the private credit exposure. Since they announced what that amount was in Q1, this will be the first data point in the Q2 results since the big four banks have disclosed their exact exposure to private credit, and we'll see how much of that's coming through. Any AI-driven expense moderation, they've obviously been adopting it and hiring less to see is there improvements in the expense side of things. And then finally, the consumer credit health metrics that we want to look at, growth rates, delinquencies, and the cadence of the reserve building there that we have there, Greg. When we turn to the charts, though, let's look at the charts. We've got the daily chart pulled up. You can certainly see that it's definitively in a primary uptrend. I mean, I've only looked at a short, narrow focus, but we have hit all-time highs just touching right about here, just 2 weeks ago, about 343 and change that JP Morgan had hit. And what we've seen since then, we see a little bit of a pullback since the start of this year. In doing so, it had formed a telltale formation that we see, which is an inverse head and shoulders pattern. You can see this. It actually, in fact, the completion happens when we see a break to the upside, which we did. We saw this big gap up move that formed with a large bodied bullish candle that started this move. We did have a bit of a dramatic sell-off when this big bearish candle. Since then, we've seen prices actually crack above to hit that all-time high that we are. We did see a pullback yesterday, of course, but today we're back in the green over here. So with the earnings, Greg, what the expectation is going to be, of course, is a $14 expected move. It's pricing about 4%, but historically, when you look at JP Morgan, it's only moved about roughly 2.5% on an earnings. Key levels I'm looking at, resistance is going to be the 330. This is a key level where we've seen closes happen, not so much necessarily the wick. So what I'm looking for in the earnings is really definitively to close beyond this level on a weekly basis. And if it can go above that all-time high of 343.25, I believe, then we're in price discovery zone. We don't have overhead supply if it can breach that level. On the downside, we're looking at 320, which is just sitting at currently the projected Ichimoku Cloud base layer support that we have. But when we look at the momentum indicators, they're still very squarely bullish. You know, you've got MACD in positive territory and rising, as well as RSI kind of just hanging out in that kind of overbought zone, but not quite into that yet. So still bullish overall on the sentiment there.
All right, you got your chart up, you got all the work done on it. Now you're going to walk us through a couple of ways we could trade JP Morgan. Before you get going, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where do you want to start this one here, in the bull or the bear?
We will start with the bull, Greg. Just let me get my page up here and we'll get this going here. We're going to start with the bull case. And before I do that, what I wanted to mention was when I analyzed the options market, The implied move, as I mentioned, was about 4.7%. That's nearly double JP Morgan's average post-earnings move that they have, which has been around 2.5% over the last 8 quarters. Now, notably, what's been key is that it has closed lower after each of the last 4 earnings reports, including a 4.2% drop in January that it had over there. So let's actually go to we'll go to our trade over here where we're talking about doing the bullish trade here. So I'm going to pull that up here and we'll resize everything for our viewers. So when I'm looking at the bullish play, Greg, we mentioned a key level was the all-time high that we had marked over here. So one of the trades you could consider being a bull is a bull call spread. So we are looking to speculate for an upside move. But the key is going to be a break above that all-time high. And that's why in setting up this trade, I've looked to buy the 345, which is currently outside of that level. So the idea is if we think that it can break there, we want to give ourselves enough time. It can certainly do a run-up, especially with the measured move on what the charts were showing with the inverse head and shoulders on the bigger head. It could potentially tag and break past this 355. So we're capping our short side at the 355 to cap our upside, but also to lower our cost. Overall, this trade is costing us a net debit of $2.65. This is a $10 wide spread. So essentially, that makes our break even at 347.65. Now we have gone a little bit further in the cycle, going out to the August expiry there. So that gives us roughly just over 90 days here, or just shy of 90 days, I should say, for us for this trade to work in our favor over here.
Okay, how about what we're putting at risk?
All right, so let's bring that up. It was a bit skewed up. So the best thing about whenever you do these spread trades, Greg, you're always doing, what you're risking is essentially what you're putting in when you're talking about debit spreads. So in this case, we are putting in $2.65. That's all we stand to lose. This is going to happen if JP Morgan doesn't break above our long strike price, 345, if we're holding it all the way till expiry. Now, the best case scenario, of course, is going to be for us is if it does go above that price and in fact gets past our short strike at 355 by our expiry date. In that case, we will capitalize on taking the spread would be worth the $10 width that we've put on there, and our profit would be just subtracting what we paid to get into this trade, and that would work out to $7.35 or $735 on a single contract when we talk about that.
All right, interesting possible strategy there. How could the other side play it?
All right. So if you're looking and if history seems to rhyme with how it's played out so far, Greg, one of the trades you could do, again, we're going to speculate to the downside because that's historically what it's done over the last 4 quarters, is putting on a long put condor strategy over here. This is a strategy that's comprised of 4 legs of options. Now, we're going further out in the cycle, out to September. The expected move on JP Morgan is, the market's expecting about a plus or minus $30 move from where it's currently sitting at right now. So the way the strategy works is we're essentially setting up 2 spreads. We're going to be setting up our debit put spread. So this is to our directional move. We're going to be buying the 325, which is out of the money at the moment. And then we're looking to sell the 305 to reduce our cost. And then we're doing a further sell of another credit put spread further out. We're going to sell the 285 further down and then cap it off by buying the 265. Now, what this does, all in all, Greg, is it reduces our overall cost down to $4.75. So that means I do need for JP Morgan to come down to at least my long strike at 325 to begin with as a starting point, but I needed to fall at least to 320.25 to just break even on this trade. And then, of course, any downside movement is going to be a bonus for us, of course. And we want to talk about those numbers. So I'm going to show this one has actually 2 break-even points. I'll explain how that works and where the risk stands with that. So I'm just going to queue up for a second and we'll talk about the max loss number, which is 475. Again, because this is a debit trade, we only stand to lose what we put in. Now, this can happen one of 2 ways. Either if JP Morgan stays above our long strike of 325, then we stand to lose that trade. Also, it can happen if it falls dramatically and breaks below our 265, then we have a second break even where it starts eating into our profits, where we would then lose the cost as well of the 475. In terms of gain, the best case scenario is just this. I've kind of highlighted this green zone here. So as long as it breaks below the break even of 325, this is our golden zone. Anything below 305 to between 285, we stand to make a max gain, and that's simply going to be the width of the spread, $20 minus what we put into it, and that works out to $15.25 there, Greg.
All right, two interesting strategies for our viewers to do their homework on. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. Next week we return. I feel like we got a theme going here. We did United Airlines this week, so you're on the plane, you get to the plane, and now what do you need?
You need somewhere to stay, Greg, of course. So we're going to put the traditional place you'd want to go to as a hotel, but this is one of the largest brands in the world, Hilton Hotels. So that's what we're going to be putting up to the debate. There's stiff competition in that business. Of course, Airbnb is also competing for those travel dollars that we have. I'll be playing the big bad bear on this one, Greg.
You'll be the bear. And if we're continuing that theme through the month, I guess we got to do a restaurant the next week, but I'm not sure that's what we have on deck. Just a thought that popped in my head. Crazy, I don't run the show. That's all the time we got for this one. Thanks for watching, and we'll see you next week.